Hi there. Welcome to the second review on corporate finance, which deals with the concept of cost of capital. Please recall from the first video that cost of capital went in as the discount rate for our NPV calculations. So let's take a quick overview of what we'll be studying today. We'll start with understanding the various sources of capital, what should be a firm's optimal capital budget, the cost of debt, equity, preferred stock, and how each one of these is calculated in detail. What is the project beta, the marginal cost of capital, and finally we'll be winding up with understanding the correct treatment of flotation costs. Now, before we delve into the details of weighted average cost of capital, let's understand the sources of financing and the cost associated with each one of them. So the first source is the new debt or debt financing. Please recall that the agreement with debt holders is that we pay a fixed rate of interest or a fixed coupon, and they do not participate in the profits or losses of the company. So there is a fixed cost associated with debt that needs to be paid to the debt holders. That cost is the yield to maturity on existing debt. So even if you don't understand what YTM or yield to maturity is right now, don't worry about it. You'll cover it in detail in the review on fixed income securities. But just recall for future reference, or just remember this, that cost of debt, KD, is not the coupon rate. It is the YTM of the debt or the yield to maturity. This is also called the before tax component cost of debt. So debt is one component of the total financing, and the yield to maturity, also referred to as KD in this review, will be the cost of debt. Now please recall from the review on financial reporting that the interest cost on debt is a tax deductible expense. That is, whatever interest I'm paying can be shown as an expense above profit before tax. So I do have to incur this cost, but I also get a tax relief. So the realized cost of debt is not KD. It is KD adjusted for the tax benefit or the tax shield that you are getting, because it reduces your profits and reduces your tax outgo, which is a cash outgo. So the cash cost of debt or the realized cost of debt is actually equal to KD into 1 minus T. This is also known as the after-tax cost of debt. T is the firm's marginal tax rate, margin implying that incremental income will be taxed at this rate, or this is the tax saving that the interest on the debt will do. So for the calculation of the weighted average cost, as we will see, we always use the after-tax cost of debt. Another popular source of financing is called the preferred stock. So preferred stock is similar to debt in that we pay a fixed coupon, just like debt. It is like equity to the extent that there is no guaranteed time to maturity, or there's no time at which we are assured that we will get our principal back on the preferred stock. So it's somewhere in the middle of debt and equity. Preferred stock is subordinated to debt. That is, in the event of a bankruptcy, preferred shareholders will get paid only if anything is left after paying the debt holders. But it is senior to equity, as we will see. Preferred stock, or the preferred dividend that we pay on the preferred stock, is not a tax deductible expense like interest cost. So because it is not tax deductible, it does not give us any tax shield or tax benefit. So whatever is the coupon we are paying, will be our cost of the preferred stock. Finally, arguably the most popular source of capital is the common equity. So this is the most expensive source of financing. Common equity holders are the owners of the company. They take big risk. They participate completely in the profits and losses. So very high profits means bigger payouts for the equity owners, and losses means no payouts or even a decrease in the value of their investment. Because they take the maximum risk amongst the three classes discussed, they also expect the maximum return. Dividends paid to equity shareholders are also not tax deductible like preferred dividends. So no tax deduction there as well. Only debt gets a tax shield or provides a tax shield. So these are some of the common sources of capital. The weighted average cost of capital will be calculated as the weight of debt into the cost of debt. This will be the after-tax cost, into the weight of preferred share into the cost of preferred shares, plus the weight of common equity into the cost of common equity. Now, very important how these weights are calculated. The weight of debt is the percentage of debt in the capital structure. We'll understand it better with an example which is going to follow. But remember that the percentage of debt, or all these percentages, are percentage of market value, not historical cost. So it is the market value of debt, preferred share and common equity that will be used for calculating the percentage of each in the capital structure. So suppose Google Incorporated's target capital structure is as follows. They want to keep 50% debt, 6% preferred shares, and 44% common equity to fund their projects. And the before tax cost of debt is 7%. The cost of equity is given to be 11%, and the cost of preferred stock is 8.2%. The marginal tax rate is 30%. Calculate Google's weighted average cost of capital. So let's apply the formula straight up, and then we will see the theory in a little more detail. So the weighted average cost of capital will be the weight of debt into the cost of debt. Please note we need the after-tax cost. The before-tax cost is 7% into 1 minus the tax rate. This will be the after-tax cost, because debt gives a tax shield, plus 0.06, that is the weight of preferred shares into the cost of preferred shares. Please, they are more expensive than the debt because there is no fixed maturity and it's higher risk than debt. And the most expensive source of financing would be common equity, which has a 44% weight and costs 11%. So we can use our BA2 plus calculators and calculate the sum. I'd like to teach you another interesting function in the calculator as we do this calculation. So the first calculation is the cost of debt, which comes out to be 0.5, or the contribution of debt rather, that is 0.5 into 0.07 into 1 minus 0.3, that is 0.7. Comes out to be 0.0245 or 2.45%. Let's store this in the memory register 1. Now let's go on to our next calculation, that is the calculation for preferred equity, which comes out to be a weight of 6% into a cost of 0.082, that is 0.00492. Now, instead of storing it in a separate memory register and then adding all the three, I can simply press the button store plus 1. What this does is that whatever value was already stored in the memory register 1 will remain as is, and the value 0.00492 will be added onto that number and stored again in the memory register 1. Let's do the third calculation, that is 44% weight into a cost of 11%. And let's do store plus 1. So the third value also gets added, and the complete sum can be viewed by simply recalling the memory register 1. So 7.782% is my weighted average cost of capital. Now, one term that I would like to stress in the question is the target capital structure. Always use a company's target capital structure. Not the existing capital structure. The reason is that normally when we are valuing our projects or we are calculating the NPV or the IRR, we are doing it or we are applying it to long-term cash flows coming over a period of many years. So even though the existing debt may be very high, but if the company plans to bring it down to a target level at the end of the year, then that's what the capital structure will be for the majority of the lifetime of the project. And that is what the capital structure which should be used for discounting back the cash flows or computing the WACC. What will be the target capital structure? You can normally get to know by your interaction with the management, and in the management discussion and analysis section of the balance sheet also this figure is mentioned. So the WACC comes out to be 7.8% as we calculated. The market values of a firm's capital are as follows. The debt outstanding of $8 million, a preferred stock outstanding of $2 million, common stock of 10, and a total capital of $10 million. What is the firm's target capital structure based on its existing capital structure? So in this case, we're saying that the target is the same as existing, so a pretty straightforward question. The weight of debt would be 8 upon total, that is 8 by 20. The weight of preferred stock would be 10% or 2 by 20. And the weight of common equity would be 50%, that is 10 by 20. A lot of times you will be asked that what is the target capital structure based on a competitor's capital structure? Or if not a competitor, based on the average industry's capital structure, or based on some other target that the management wants to achieve. So in that case, make sure that you don't use the existing, rather you use the competitors or whatever other capital structure the question is directing you to. So always use the target capital structure, and very importantly, always use the market values of debt, preferred stock, and common equity when you're calculating. That is, if you today were to buy out the entire debt, or you were to buy out the entire preferred stock or the entire equity, that is, pay the market cap of the company, that will be the value or the market value of the common stock, then what is the money that you have to pay? Use those values for calculating the target capital structure, not the historical values or not the cost. If nothing is mentioned about the market value or the cost, then you can use whatever figures are there in the question to calculate the weight of debt and the weight of preferred share and common equity as we've discussed. Now, a very interesting graph that tries to explain what is the optimal capital budget that a firm should have? That is, what is the maximum amount of capital that we should raise and invest? Or what is the amount of debt and equity as a company and on the whole should we have? In most businesses and in most projects, what we will see is, now focus on the first curve. The left hand side for this curve is the project IRR, and the x-axis is the new capital invested. So as we invest newer and newer capital into the business, what will happen to the project IRRs? Do you agree that the first shop that I open, or the first retail outlet that I start off with, will have a very high IRR because it's what gave me the idea to start the business, because I saw a begging opportunity or a big arbitrage opportunity because there was no cleaning shop or stationery shop, whatever shop that I'm opening. So the first shop will have a high IRR because it's the opportunity that I'm grabbing on. As I expand to the second and to the third store, you think all localities in the city or in the country will have such a huge arbitrage or such a huge shortage of cleaning stores or stationery stores, whatever I'm opening? So in most businesses, as we expand the business or as we invest new capital into the business, the investment opportunity starts to come down. That is, incremental projects are not as profitable as the original one. So the IRR of the projects will start moving down as I invest more. So that's one half of the curve that we need to understand. Now for the second curve, the y-axis or the left hand side is the cost of capital, and the x-axis is the new capital raised. That is, as I raise more and more capital, as I raise more debt, and as I raise more equity, what will happen to my cost of capital? The cost of capital will keep moving up, because lending $10 to me, or for me to borrow $10, is easy. It's just a small amount of loan that I have taken. Or asking my friends and family to put in some money into my business is easy. But as I expand bigger and bigger, or I invest new capital into my company, the incremental funding may get tougher, because anyways investors are not seeing the opportunity. So both debt holders and equity holders are now asking for a slightly higher cost of capital. So that's the second curve. That is, as you raise new capital, the cost of capital tends to go up. So it brings us to the question, what should be the optimal capital budget, or where should we stop raising new capital? Now at point A, the cost of capital, let's say, is around 5%, and the opportunity available is to the tune of 10%. So should A units of money be raised, and should it be invested? Yes, because the opportunity justifies the cost, and we should expand, or we should open this store. Similarly, till the time the project IRRs are higher than the cost of capital, as we studied in the previous review as well, the stores should be opened or the money should be invested. Beyond the optimal capital budget, that is beyond this point, if we raise more capital and invest it, then we'll see now that the cost of capital has become 10%, and the investment opportunity is only to the tune of 3%, or project IRR is only 3%. So does it make sense to invest this money? We will only be destroying value. because we are paying 10% to our capital suppliers and earning only 3%. So where the marginal cost of capital is exactly equal to the project IRR is where we should stop raising new capital and stop investing into expanding the business. That's the concept of optimal capital budget. We'll now study the individual components of costs of capital, that is debt, preferred stock, and equity, in a little more detail. So let's review the concept of cost of debt. Morgan Incorporated is planning to issue new debt at an interest rate of 7%, and Morgan has a 35% marginal tax rate. What is Morgan's cost of debt capital? So interest rate, you can assume here, is the yield to maturity on the debt. This yield to maturity will depend on many things. It will depend on the credit rating. It will depend on the interest rates in the economy. We'll study these concepts when we study fixed income securities. Remember, the before tax cost is 7%. But for calculation of the cost of capital, what we are interested in, or what matters more, is the after tax cost, because the tax shield is a very real benefit that debt gives me. The after tax cost will not be so expensive. It will be 7% minus the tax benefit that I'm getting. That is 7% into 35%, or 7 into 1 minus 0.35. Comes out to be 4.55%. So just like the yield to maturity was the cost of debt, we can compute the cost of preferred stock as the yield on the preferred stock. So please recall from the session on quant that the price of a perpetuity is given as the cash flow, which is the dividend that the preferred stock is paying, upon the yield or upon the discount rate. So the discount rate, or the yield on the preferred stock, that is the cost of the preferred stock, can be derived as the dividend upon the price. Suppose Morgan Incorporated has a preferred stock that pays a $9 dividend per share and sells for $100 per share. What is Morgan's cost of preferred stock? So the cost can be derived as the dividend that it's paying upon the price, that is equal to 9%. Now, there are many ways of calculating the cost of equity, and a lot of these we will study in reviews of equity valuation and portfolio management. However, let's understand a few models and at least the application of them. So the first approach is called the capital asset pricing model approach to calculating the cost of equity. The proof of this equation will be given in the review on portfolio management. So just remember for now that the cost of equity is given as the risk-free rate plus beta times the expected return on the market minus the risk-free rate. This is also called the risk premium, or the market risk premium. So let's go through in detail the steps to applying this method. So step 1 is to estimate the risk-free rate. That is the first input. So you can normally use the short-term treasury bill rate. These are short-term government securities maturing in less than 1 year, and the interest rate that they are giving can be used. Or some analysts prefer to use the long-term treasury rate, since they claim that the valuation is for a longer term. So the longer-term government bond rate should be used as the risk-free rate. Either way, both are government securities and both are risk-free, and they can be used as the risk-free rate. Once you've estimated the risk-free rate, you need to estimate the stock's beta. So beta is a risk measure. We will explain it in detail in another review, but understand it is defined as the percentage change in the stock for a 1% change in the market. So if the beta of a stock is equal to 2 units, what it means is that if the market goes up by 10%, the stock will go up by 20%. Or if the market falls by 10%, the stock will fall by 20%. So it's a measure of how risky the security is. So a beta of 2 would be classified as a relatively risky stock. A beta of 0.5 would be a less risky stock. That is, even if the market goes up or down, this stock doesn't go up or down as much. So how to estimate the beta, we will study in portfolio management. It is defined as the covariance of the stock with the market upon the variance of the market. We will prove this in portfolio management. Estimate then the expected rate of return on the market. Not very difficult to do. We can again have various methods to estimate this. We can compute the average stock market return over the last 10 years or over the last 15 years, whatever we feel is a good representation. And in subsequent chapters and in level 2, we will study in a lot more detail how we compute the expected return on the market. Once you have the three inputs, the beta, the expected return on the market, and the risk-free rate in the first 3 steps, you can then input them into the capital asset pricing model. This equation is called the CAPM, and compute the required rate of return or the cost of equity. Now, this is the return that equity holders demand for investing into your project. Let's do an example. Suppose the risk-free rate is 7%, the return on the market is 10%, and Morgan has a beta of 1.1. Estimate Morgan's cost of equity. So cost of equity is the risk-free rate, that is 7%, plus beta into the expected return on the market minus the risk-free rate. You could either enter them as 0.07 or as 7%, won't make a difference. So it will give us 7% plus 3.3%, that is equal to 10.3%, that is the cost of equity. This was the first method of calculating the cost of equity. The next approach is called the dividend discount model, and this we will study when we study equity valuation. So we will learn there that if dividends are expected to grow at a constant rate of G, so let's say 5% is the expected growth rate, that is a dividend of, let's say last year 10, will next year become 10 into 1 plus 0.05. The year after that, in year 2, will become 10 into 1.05 to the power 2, so on and so forth. So if dividends are expected to perpetually grow at a constant rate of G, then the current stock price can be calculated by this formula. This is called the dividend discount model, or also known as the Gordon growth model. So the price today at t equal to 0 is equal to the next year's dividend, or the dividend coming at t equal to 1, upon the cost of equity minus G. So D1, very importantly, remember guys, is the next year's, not the last year's. So if the last year's is given in the question, you will have to estimate the next year's dividend. KCE is the calculation that we need, that is the required rate of return on common equity, and G is the firm's expected growth rate. So if we know P0, we know D1, and we've estimated the growth rate G, can we compute KCE? So we can write that KCE, or the cost of equity minus G, is equal to D1 by P0, or Kc is simply equal to d1 by p naught plus g. So if we rearrange the terms, we get this. Now, in order to apply this formula to calculate KCE, I need to first estimate G. This can be done in various ways. So, one way is to just use the growth rate as projected by various security analysts and what they feel about the growth rate G. Another method that we have studied in financial reporting, if you've already seen that video or you can check out that video, is to calculate G as the retention rate multiplied by the return on equity. So this theory says that the company will grow only if it reinvests. If the company chooses not to reinvest, then it will just sustain the current level of business at best. It will not grow. Retention rate tells us how much am I reinvesting. And return on equity is the return that I'm additionally making on that reinvested earnings. So whatever I'm reinvesting is going to contribute to the growth to the extent I'm able to earn a return on it. Please watch the review on financial reporting to understand the details of this proof. So remember that retention ratio into ROE is another way of calculating G. Retention ratio can be written as 1 minus the payout ratio into the ROE. Suppose Morgan's stock sells for $20 and next year's dividend is expected to be $1. Morgan's expected ROE is 11% and Morgan is expected to pay out 30% of its earnings. What is Morgan's cost of equity? So the stock price is known. Let's refresh the Gordon growth model. P naught is given by D naught upon K minus G. We have to estimate the K. P naught is given to be 20. Next year's dividend is expected to be $1. The ROE is 11 and the payout ratio is 30%. So G can be written as retention ratio into ROE. Retention ratio in this question is 1 minus the payout ratio, that is 1 minus 0.3 into the ROE, which is 11%. Or the growth is expected to be 0.7 into 11%, that is 7.7% sustainably. Please note, this is the constant growth rate expected till infinity. The next year's dividend I know. The growth I know at 7.7%. Can I calculate K? Or K can be written as 1 by 20 plus 0.077. So let's use the calculator. 1 divided by 20, 0.05 plus 0.077 gives us 12.7%. Well, that is the cost of equity. One last approach that is used as an ad hoc method by analysts, that is it's not as complicated as the first two that we've studied, is simply the bond yield plus risk premium approach. So analysts theoretically argue that equity holders assume more risk than debt holders or bond holders. Hence, they will charge a higher return for supplying their capital, because they don't have any fixed time to maturity, they don't have any fixed guaranteed payment or any collateral. So they need a premium over whatever is the bond yield or whatever is the cost of debt currently to invest in the equity. So the cost of equity is the bond yield, that is the yield on the long-term debt, plus a risk premium. This re-premium historically has been seen to be around 3 to 5 percentage points, but really depending on the economy and the state of affairs, the premium can be much higher or lower. In good times, this premium is lower. In bad times, this premium becomes higher. So Dexter's interest rate in the long-term debt is 9%. Suppose the risk premium is 4%. So what will be the cost of equity? It will be the yield on the debt plus the premium, that is 13%. We'll now try to understand the concept of project beta. So let's recall the definition of beta. It is the percentage change in the stock for a 1% change in the market. If the beta is high, we said the stock is more risky. If beta is low, the stock is less risky. Now, why does risk come in businesses? Or why are some stocks more risky than the other? So a part of the risk, or one source of risk, is the business model itself. Now, if the economy goes into a boom, will you start bathing 10 times in a day? Or if the economy goes into a recession, will you stop taking a bath? Likewise, you don't start eating medicine or stop eating medicine just because the economy is in a boom or the economy is in a slump. So FMCG companies, pharmaceutical or healthcare companies generally have stable growth rates or stable businesses because the business model per se is not very risky. Automobile companies, on the other hand, or real estate companies, have a riskier business model because if the economy goes into a boom, the prices can soar or the sales can multiply. But in times of recession, the exact opposite can also happen, or sales can dip very sharply and costs can remain high and it can affect profits and earnings quite adversely. So the business model per se is more risky, and in the case of FMCG companies, it is less risky. So autos, real estate would be expected to be having a higher beta as compared to less riskier business models. So that's one source of risk or why beta exists. Now, even for the same business model, that is, even for two FMCG companies which are in the exact same business, let's assume soap manufacturing and selling, the risks can be different. That difference comes because of the extent of leverage or the use of debt. As we will study very soon when we study measures of leverage in corporate finance, that leverage increases the variability of earnings. So for the same business, if I had funded it without debt, the risk would be lower. And if I had funded it using a lot of debt, the risk would be higher because, please note, debt is a fixed cost. Even if I make no sales, I still have to service this fixed cost somehow. And it can cause big losses in bad times. But on the flip side, if things go really well, then I don't have to share my profits with anyone, with no equity holder, because the cost of debt will still remain fixed. So a part of the risk comes from the business model itself. A part of the risk comes because of how much leverage you have. So please understand, if it's a real estate company with a lot of debt or with a lot of leverage, then it's a very risky proposition. Or if it's an auto company with a lot of leverage, then if things go bad, the company can go bankrupt. Now, the reason we're analyzing this is because a lot of times beta is difficult to estimate for small companies or for small projects. Please recall, the way we calculate beta is from historical data. So historically we see how much has the stock changed for a 1% change in the market. Our beta was defined as the covariance of the stock with the market upon the variance of the market. Now this calculation can be easily done for a public company that has listed 10-20 years of history, and the stock price data and the market performance data is very easily available, and I can do this covariance and this variance, and I can take the ratio and calculate the beta. But for smaller companies which are not listed or which are not very liquid, even if they are listed, and for projects, individual projects, this beta would be tougher to estimate because no such data exists of the stock market or the stock price. So the estimation of that beta is essentially what we're going to learn in project beta. So how do we estimate the beta when we don't have this covariance variance metric available with us? So there's a few steps we will follow. First is we will try to find a listed company in the same business. Once we have done that, then we at least have some indication of the beta from that listed company. If that listed company is exactly in the same business, or if both are FMCG companies, broadly for estimation we can say that the business risk is going to be the same. Or that is the assumption we go with, that if it's a company in the same business, then the business risk can be assumed to be the same. But again, the two companies, even though in the same business, even though both are FMCG companies, can have different amounts of leverage and hence different amount of risk or different beta. So the second step is called unlevering the beta. That is, whatever your listed company's beta is, this would be accounting for the leverage of the listed company. So if the listed company has a lot of debt, then the beta would be higher. If the listed company has less debt, then the beta would be lower. So my project's debt equity may be different than this listed company. Business may be the same, but debt equity may or may not be the same. So the second step is unlevering the beta. That is, from this listed company's beta, just find out the risk of the business, ignore the impact of debt. So we say that beta of the asset is given as, or beta of asset means beta of the business, just the business risk is given as the beta of equity. Equity will have both risks incorporated, the risk of the business model as well as the risk of debt. So from this, we are taking away this leverage risk. So we'll do that by dividing it by 1 plus the debt to equity ratio. Please note this has to be of the listed company, into 1 minus the tax rate of the listed company, because debt gives it a tax relief. So D we multiply into 1 minus T. But please note, both of these, the debt equity ratio as well as the tax rate, need to be of the listed company. And then to compute the beta of the project, I would use this asset beta calculated in the first step and re-lever it, or lever it again, but now to my debt equity ratio, or the debt equity ratio that I am working the project with, because the business risk is the same. of both the listed company as well as my company, because we're in the same business. So I've got the business risk here, and now I will relever it. The third step, we'll call it relever, or start with beta of the business into 1 plus D by E. Now this D by E is of your project into 1 minus the tax rate of your project to compute the beta of the project. This beta then can be used in the CAPM as you did earlier to compute the cost of capital for the project. That was RF plus beta times RM minus RF. Let's understand this concept a little better with the help of an example, and you'll understand why we're dividing it and multiplying it again. So just the formulas again. Beta asset is beta equity into 1 upon 1 plus 1 minus T into D by E. Remember, both of them have to be of the comparable company, not your project. This is the comparable or the listed company, which has an easy beta available, for which the beta equity is easily available as covariance upon variance. We can then estimate a beta project using this beta asset. This is the risk of the business, and add to it the risk of the debt. That is, relever it. This D by E and this tax rate both are now of your project that you are estimating the beta for, or you want to estimate the cost of capital for. Apple Incorporated is considering a project in the telecom business. It has a debt equity ratio of 2, a marginal tax rate of 40%, and its debt currently has a yield of 12%. Ricardo, a publicly traded firm that operates only in the telecom business. So see, that's going to be our comparable. It's publicly traded and it operates only in the telecom business. So the business risk of Ricardo and our project will be the same. However, Ricardo has a debt equity ratio of 1.4, a marginal tax rate of 40%, and an equity beta of 0.8. The risk-free rate and the expected return on the market is given to 6% and 11%. Calculate Ricardo's asset beta, the project's equity beta, and the appropriate WACC. So we need the project beta to calculate the cost of capital or the WACC. However, the beta for the project cannot be easily estimated, so we take help of a comparable, which is Ricardo. Ricardo's beta is equal to 0.8. But this is the equity beta. The equity beta will have a representation of both risks, the business risk as well as the debt, or the debt equity ratio 1.4. So we want just the risk of the business, not the risk of the debt. Please note, just the business risk will be lower than both risks combined. That is why we start with the equity beta and we divide it by 1 plus the debt by equity ratio. Because there is a business risk and then there is a risk from the leverage which gives the equity beta. If I'm stripping out the risk from the leverage, then only the business risk should be lesser than the business risk and the leverage combined. Hence I divided by debt to equity, which is 1.4 into 1 minus 0.4. So this is the risk of the business. Let's do it on the calculator. So 1.4 into 0.6 plus 1 is 1.84. We'll store this in the memory register 1, and then 0.8 divided by recall 1 will be 0.4347. So the business risk or the asset beta is 0.4347. Now to compute the beta of our project will definitely have this business risk, but it will also have additional risk coming from the debt that we are taking or the leverage that we are taking. Guys, why this additional risk comes, you'll understand better when we study measures of leverage in corporate finance in the next review. So beta of the project, we'll start with the beta of asset, but this is what we had stripped out. Now we will add it back again corresponding to our project's leverage and our project's risk. So into 1 plus d by e into 1 minus the marginal tax rate, all of them for our project now, that is 0.4347 into 1 plus 2, that is the debt equity of our project, into 1 minus 0.4. Which will be 2 into 0.6 plus 1 into 0.4347. That is 0.9564. So it comes out to be approximately 0.956. Now this beta of the project equity or the beta of the project can be used in the CAPM equation to compute the cost of equity for the project as the risk-free rate, which is 0.06, plus beta into the expected return on the market minus the risk-free rate. Please note both the risk-free rate as well as the expected return are given in the question. So 0.956 into 0.05 plus 0.06 is approximately equal to 10.78%. And then the WACC is a simple calculation. It is the weight of debt into the cost of debt. Please note it is the after-tax cost plus the weight of equity into the cost of equity. So what is the weight of debt in our question? Please note the debt equity ratio is 2. So the debt divided by the equity is equal to 2 upon 1. Total capital is debt plus equity. So how much would be debt upon debt plus equity? So if debt is 2 and equity is 1, for the sake of calculation, then it will be 2 upon 2 plus 1, that is 2 by 3. And similarly, equity upon debt plus equity, that is the weight of equity, will be given as equity is 1 and debt is 2. 1 upon 2 plus 1, that is equal to 1 by 3. So weight of debt, that is 2 by 3 into the cost of debt. And the debt currently has a yield of 12% and the marginal tax rate is 40%. This is the before tax cost. I need the yield to maturity, but I need to adjust for the tax benefits that the debt is giving me into 1 minus 0.4 plus weight of equity, that is 1 by 3 into 10.78%. Can easily be solved on our calculator and will come out to be approximately 8.395%. That is the WACC for the project. An interesting question, important question. Two important concepts that we use here, actually you'll study a little later. First is the beta and second is the impact of leverage, but you still should understand the broad steps that we follow to solve the question for the exam. Now, while we use the beta as a risk estimate in the CAPM calculations, there are certain issues with beta that we should be aware of. First is that beta, as we discussed, was a covariance upon the variance. So this data for calculating the covariance as well as the variance normally comes from historical returns. And what returns data do I use? Do I use daily returns, weekly returns? And how many years of such returns should I consider? Or the length of time, that is the last 10 years daily returns or the last 5 years weekly returns, are all decisions that need to be taken, and all these choices will change the estimate of beta. So the estimate is quite sensitive to all these factors. How do I define the market? So we said covariance of the stock with the market upon variance of the market. So which index do I choose to represent the market will affect the estimate. Now, we've seen that as countries become developed, industries mature, the riskiness in the businesses reduces. That is, most industries reach a mature stage where there are only a few good companies remaining, and their growth is dependent more on the GDP growth and the economic or the macroeconomic growth. That is, the risk or the riskiness of the country as a whole reduces as development happens. So betas are believed to revert towards 1 over time as the country becomes developed. So because we are using the beta estimate in calculating cost of capital, which is used for discounting long-term cash flows, the estimate of beta may need to be adjusted for this tendency of reversion towards the number 1. We will study how to incorporate this in later reviews, but that's another issue that you should be aware of. And finally, like we studied, beta estimates for small cap firms or small companies and projects may need to be adjusted upward to reflect additional risks that are inherent in smaller firms, that is low liquidity and corporate governance may not be as good, etc. So this is the risk that is not captured by the usual estimation methods. So we're not being asked to not use the beta estimate or the CAPM method, but it's just some issues with beta that we should be aware of while we are using our estimation. Now, when we invest in foreign countries or in another country, oftentimes we may need to apply a country risk premium because of various sovereign factors and additional risks that come in when you're investing outside of your home market. And this premium is particularly important when a developed market investor is investing in an emerging market. Because the emerging market may have other idiosyncrasies and other risks that the developed market investor may need to factor. So the CAPM equation changes when we're investing in another country as RF plus beta times RM minus RF plus a country risk premium. So please note, if a US investor is investing in Latin America and Mexico, then the required return on equity that the investor will demand will be given by this equation. The risk-free rate he will still use as the same as the US risk-free rate or the risk-free rate in his home country. The beta will be the beta of the Mexican stock with the global market or with the US market or whatever is the home market, not with the Mexican index. So if he's using the US risk-free rate, if he's a US investor, then he may use the US risk-free rate and the beta with the US market. The expected return on the market will again be the global market if he's a global investor or the US market if he's the US investor. He will additionally add a country risk premium to account for the additional risk that comes because he's investing in an emerging market or in Mexico. So CRP stands for country risk premium. Now an ad hoc estimate of the country risk premium is the sovereign yield spreads. That is, take the yield on the Mexican government bond and subtract the yield on the US Treasury bond. The difference in these yields will give us some indication of the additional risk in Mexico. So this yield will be higher, or Mexican bonds will have to give us a higher interest rate, Mexican government bonds, okay, as against US government bonds, because of the higher risk of investing in Mexico. This is called the sovereign spread or sovereign yield spread. However, a more precise calculation of country risk premium starts from the sovereign spread, but realizes that sovereign spread is just the difference in debt yields. When we are using the CAPM, we are trying to estimate the cost of equity. So the country risk premium applicable to equities is given as the same sovereign yield spread multiplied by how risky equities are as compared to debt. So this is the riskiness or the additional riskiness of the debt market. We are trying to see the additional riskiness of the equity markets because we are trying to see the cost of equity. So see how risky the debt is and then multiply it with the standard deviation of the equity index of Mexico upon the standard deviation of the sovereign bond market of Mexico in terms of US dollars or in terms of the developed market currency. So Mexican debt itself is more risky than US debt to this extent, to the extent of the sovereign yield spread. And then Mexican equity is more risky than Mexican debt to this ratio or to the extent of this ratio. So standard deviation of the equity index is the risk of equity, divided by standard deviation of the bond market is the risk of the bond market. So the actual country risk premium applicable to equity is given by the sovereign yield spread, that is the difference between the yields of government bonds in the developing country and the treasury bonds of similar maturities, treasury bonds of the US or the developed market. Multiply it with the volatility of the equity index of the developing country upon the volatility of the bond index in the developing country. Please note, the currency in use will always be the US dollar. So both these volatilities will be in terms of US dollar. They will be for the emerging market only, but they'll be calculated in terms of the developed market currency. Let's do an example and understand it. Samuel Peter, an analyst with Acme Corporation, is estimating a country risk premium to include in his estimate of the cost of equity for a project Acme is starting in India. Peter has compiled the following information for his analysis. India US dollar denominated 10-year government bond yield is 8.5%. The 10-year US Treasury bond yield is 4.9%. So can we compute the yield or the sovereign yield spread? It will be given as 8.5 minus 4.9. That is 3.6%. The annualized standard deviation of the Indian stock index is 34%, and the annualized standard deviation of the Indian US dollar denominated 10-year government bond is 22%. So with the information in the first 4 points, can we compute the country risk premium? It will be the sovereign yield spread, that is 3.6%, multiplied by, so this is the difference in just the debt. How much more risky is equity as compared to debt? 34% by 22%. We can do it on the calculator. It'll be 3.6 into 34 divided by 22, which is 5.56%. The project beta is equal to 1.5 units. The expected market return is 10.5 and the risk-free rate is 4.3%. So calculate the country risk premium. We've done that. That is 5.56%. And the cost of equity for Acme's Indian project. Cost of equity will be the risk-free rate plus the beta into the expected return on the market minus the risk-free rate plus the country risk premium. So again, please use your calculators and calculate the answer. Verify that it will be equal to 21.71% approximately. We now move on to the concept of marginal cost of capital. So the name suggests, marginal cost of capital is the cost of raising incremental funding or incremental capital. If I invest more and I raise more money, then that money is going to come at what cost? We'll now understand the concept of breakpoints in the capital structure. So breakpoints occur as the cost of any component of the company's WACC changes. So either the cost of equity changes or the cost of debt changes. A breakpoint can be calculated as the amount of capital at which the component's cost of capital changes divided by the weight of component in the capital structure. We'll explain that with the help of an example. So the H&V Corporation has a target capital structure of 70% equity and 30% debt. The schedule of financing costs for the H&V Corp is shown in the figure below. That is, if you take $0 to $99 million of debt, your cost will be 4.3%. As you take $100 to $200 million of debt, the entire cost of debt will become 4.5%. And between $200 to $300 million, the cost becomes 5.2%. Similarly, the first $200 of equity will come at 6.6%. If you raise $200 to $400, then the cost of the entire $400 of equity will become 8%. And if you raise between $400 to $600 of equity, then the entire cost of equity will go up to about 9.4%. Question asks, calculate the breakpoints for H&V Corporation and the marginal cost of capital schedule. So breakpoint is where your WACC will change or where the cost of either debt or equity, that is any one component, changes. Now for the first $100 million, the cost of debt will remain the same. So an increase in cost of debt will come when debt goes above $100 million. When will that happen? Debt is what percentage of the total capital? It's only about 30% of the total capital. So let's assume X is the total capital at which the cost of debt goes up. That means 30% of X should be greater than or equal to 100. That is, the amount of debt should increase $100 million. So if X is the total capital, then 30% of it should increase 100, or the first breakpoint will occur, or one breakpoint will occur as the total capital goes above 100 by 30, that is $333.33 million. Similarly, as equity goes above $200 million, the cost of equity will change. If the cost of equity changes, again the WACC would change. So equity is 70% of the total capital. As 70% of the total capital exceeds $200 million, again the WACC will change, or there will be a breakpoint. So it will be 200 upon 0.7. This can be calculated as 200 divided by 0.7, which is $285.71 million. So a breakpoint will come when the total capital exceeds $285.7 million. Another breakpoint will come when the total capital exceeds $333.33 million, so on and so forth. For each level we can calculate. So a breakpoint will come at every amount at which the component's cost of capital changes upon the weight of that component in the capital structure. So another breakpoint will come when debt exceeds 200, that is total capital exceeds 200 by 0.3, or 400 by 0.7 for equity. And at each of these levels, we can calculate the exact WACC also. So let's take two examples. That is, let's assume the company has $200 million, and then let's assume that the company has $400 million of total capital. In both cases, let's try to compute the WACC. So in the case of $200 million, what will be the equity? Now let's do it on a fresh slide. So if I have $200 million, my debt will be 30% of it, that is $60 million, and equity will be $140. At $60 million, what is the cost of debt? 4.3. And what is the cost of equity at 140? 6.6. So it will be 4.3 into 30 plus 6.6 into 70%. Weight of debt into the cost of debt. This is the after tax cost of debt. Let's calculate. 4.3 into 0.3, store it in 1, plus 6.6 into 0.7, so plus 1, and then you can recall 1. So the cost of capital in this case would be 5.91. Similarly, if the total capital was $400 million, then debt would be 30% of it, that is 120, and equity would be 70% of it, that is $280 million. At 120, the cost of debt is 4.5%. Okay, this is the cost of total debt, not just the incremental debt. And it's the after-tax cost, so it will be 4.5%. And the cost of equity would be at $280 million, 8%. Let's compute the WACC again. It will be 4.5 into 0.3 plus 8 into 0.7. That is 4.5 into 0.3. Store it in 2. 8 into 0.7. Store plus 2. And you can recall 2 to see the sum, that is 6.95%. So the WACC keeps going up as you raise more and more capital. A breakpoint will come at each of the levels that we discussed. That is 100 by 0.3, 200 by 0.3, 200 by 0.7, and 400 by 0.7. So as the total capital exceeds these levels, the WACC will change. At $50 million, the WACC is 5.91%. At 285, it becomes 6.89. At 333, it's 6.95, so on and so forth. This is the total capital. Equity is 70%, and you can see from the table what will be the cost of equity. Debt will be 30% of the total capital, and you can see the cost of debt. Do the weighted average, and you'll get the WACC at different points. So we studied earlier as well that as you invest more and more, your cost of capital keeps going up. So the last concept for today deals with the concept of flotation costs. Please remember, flotation cost is the cost of raising equity. As compared to debt and preferred capital, raising common equity or raising equity capital is a lot more expensive. You need to hire an investment banker, market the issue, and then you get the capital in your account. We'll study in more detail in equity valuation the process of raising equity, but it's an expensive exercise, and the correct treatment of flotation costs is that the costs of flotation should be added to the initial cost of the project. So let's do an example and understand the concept better. Sarkozy Corporation is considering a project that requires a $400,000 cash outlay and is expected to produce cash flows of $150,000 per year for the next 4 years. Sarkozy's tax rate is 40%, and the before tax cost of debt is 6%. The current share price for Sarkozy's stock is $35 per share, and the expected dividend next year is $2 per share. Sarkozy's expected growth rate is 6%. Assume that Sarkozy finances the project with 60% equity and 40% debt, and that the flotation costs of equity are 4.5%. The appropriate discount rate for the project is WACC. Calculate the NPV using the correct treatment of flotation costs. Like we studied, flotation costs should be added to the initial cost of the project. The flotation costs are given to be 4.5% of the equity capital raised. So the total cost of the project is given to be $400,000, of which how much will be equity? It will be 400,000 into 0.6, that is $240,000. Of this equity capital raise, 4.5% goes into investment banking fees, marketing, and other expenses for raising this equity. So let's calculate how much this amount comes out to be. So it will be 240,000 into 4.5%. That is $10,800. So $10,800 needs to be spent additionally for raising equity. Now the appropriate discount rate is the WACC. And the question asks to calculate the NPV. So let's first calculate the discount rate, and then we will use it to discount back our cash flows. So the cost of debt is given to be 6% before tax, or the after tax cost of debt would be 6% into 1 minus the tax rate, that is 40%. So it should be equal to 3.6%. before tax cost is 6% and the tax rate is given to be 40%. The share price is given to be $35 and the expected dividend next year is $2 per share. The expected growth rate is 6% and we are asked to compute the cost of equity because we will need this as a component to our WACC calculation. So PA can be derived as 2 by 35 plus 0.06. Divided by 35 plus 0.06, that is 11.71%. 60% is equity and 40% is debt. So the WACC will be 60% into the cost of equity, that is 11.71, plus 40% into the cost of debt, that is 3.6. 0.6 into 11.71, store it in 1, and 3.6 into 0.4. The discount rate comes out to be 8.466%. So we now have the discount rate. We need to project our cash flows and apply this discount rate. So at t equal to 0, this project requires an upfront cash outflow of $400,000. But not just that, for raising the equity, I will have to spend another $10,800. So the total cost will be $400,000 minus $10,800, or 400 plus the $10,800 at t equal to 0. From t equal to 1 to 4, the project generates $150,000 in cash inflow. And likewise at t equal to 4. So we now have the cash flows for the 4 years. We have the discount rate or the WACC. We can use the cash flow sheet and compute the NPV as we studied in capital budgeting. So let's use the cash flow sheet of the calculator and calculate the NPV. So at t equal to 0, I have a negative cash flow of 400,000 plus 10,800, or a total negative cash flow of 410,800. Press the button plus minus and press enter. Please make sure that you've cleared your work when you enter the cash flow sheet. So in fact, just to be sure, we will do that. So press second and press clear work so that any previously entered values get removed. And now we can enter our cash flow as 410,800 negative. Scroll down. We then get a cash flow of $150,000 that repeats itself for the next 4 years. We don't have to enter 150,000 again for the next 4 years. We can simply enter the frequency as 4 and press enter. The calculator will know that for the next 4 years, a cash flow of $150,000 is coming. Scroll down and you'll get back to your CF0. Now press the button NPV, and we know the discount rate is 8.466%. press 8.466 and press enter. Scroll down again and compute the NPV. It comes out to be approximately equal to NPV of the cash flows comes out to be $8,098.9. So this is the correct treatment of the flotation costs. They should be added to the initial cash outflows. So please verify the calculations. So we've now understood capital budgeting and the concepts of cost of capital, both very important concepts for the exam. Please practice a lot of questions from the question bank. And thank you.